Wealthy investment secrets unveiled for every budget. Have you ever wondered how rich investors differ from poor investors? And how their approaches and investment strategies differ? In this video, we will analyze their approach to investing and what sets them apart. If you appreciate the video, we invite you to subscribe to our channel and support us with a donation. Thanks to your help, we will be able to continue producing high-quality content and constantly improving our channel. You can do it here below, through the appropriate buttons, subscribe, and thanks. Before we dive into the video, it's necessary to use YouTube's algorithm, so click on the like button to understand the difference between the two. The net worth of the rich is made up of stocks of listed and unlisted companies, real estate, and personal investments such as works of art, cars, and aircraft. The secret is not only in their investment strategy but also in understanding the basics of money movement, a concept that unfortunately, the poor do not understand. The rich also know how to take and validate calculated risks. But we'll talk more about that later in the video. For now, let's try to understand how to invest wisely like the rich, as opposed to the average person. 1. Invest in emerging markets. There is a perception that developed countries, such as the United States and the EU, offer the highest returns and safest investments. As a result, most people already invest in developed countries. There's nothing wrong with this, but the greatest opportunities lie beyond national borders, and that's where the rich look for high-yield opportunities. Some of the top countries where the rich are currently investing include Chile, Singapore, and Indonesia. It's important for an investor to conduct thorough research on these emerging markets, as ultra-rich investors do. During the research, a key decision-making factor should be whether these markets fit your investment portfolio and overall investment strategy. Emerging markets are risky, but remember, the higher the risk, the higher the return. 2. Don't invest only in tangible assets. When it comes to investments and investment strategies, many people think of bonds and stocks first. Although these types of investments are valid, a full portfolio of different investments is necessary, not just a portfolio composed of these assets. High net worth and ultra-high net worth investors understand some things. They know the value and risks of owning illiquid assets. Therefore, they carefully select the appropriate legal structures and allocate their funds accordingly. They invest in assets such as commercial and personal real estate, gold, art, and land. This way, their portfolios favor the asset class related to the real estate sector. Thanks to the diversity of assets, they balance the volatility of stocks. Despite the importance of investing in physical assets, it's understandable that small investors shy away from them due to the lack of liquidity and high initial prices. However, if you see rich people investing smartly in these physical assets, maybe you should too. In any investment portfolio, the rich and super rich hold illiquid assets, some of which may not be correlated with the market but can be useful in an investment portfolio. The positive aspect of these assets is that they are not subject to rapid market changes and end up paying off if observed over time. Between June 2006 and June 2016, Yale University Endowment implemented a strategy that used uncorrelated physical assets. In this period, it produced an average annual return of 8.1%. 3. Invest in public and private markets. Rich and ultra-rich investors realize that much of their wealth is generated in the private market, as opposed to the public or open market. Wealthy investors derive much of their wealth from private companies, owning a business, or becoming angel investors in private equity. Large endowment funds, such as those managed by Stanford University and Yale University, use private equity investments to generate high returns. This also brings diversity to the fund. Taking calculated risks. Both the public market and private equity market have risks and returns. However, this is where high net worth investors differ from low net worth investors. They take risks that usually pay off and reap huge benefits. It's important to do research to avoid losing your money if the company's growth does not meet your expectations. 4. Savings strategies in financial planning. Investing is a necessary step on the path to wealth. When you start this journey, don't forget the importance of a savings strategy. The richest investors view financial planning as a dual strategy. This means that they invest and save wisely. This means that wealthy investors focus their time and energy on increasing cash inflows and minimizing cash outflows, thus increasing their overall wealth. Given their lavish lifestyle, it's unlikely that wealthy investors are good savers. However, they know that by living within their means, they can achieve the desired level of wealth in the shortest possible time. Unfortunately, this is not true for other low-wealth investors or the poor. The poor spend more than they earn, which can ruin their savings strategy. However, it's easy to avoid overspending to achieve your goals. 5. Tax-sensitive investing. A United States trust study found that more than half of wealthy investors agree with their investment decisions. Considering the tax consequences is better than seeking higher profits without considering the tax consequences. What matters, in the end, is net income, or the amount actually earned after taxes. Moreover, no one wants their money to be involved in tax problems. Incorrect tax management of an investment can result in a loss of up to 40% of profits each year. A wise investor will ensure that this does not happen. When investing or considering investment options, it's good to be aware of the tax implications of the investment products being considered. Make sure that the returns are secure and do not decrease due to incorrect tax management. For example, investors can allocate their retirement savings to tax-advantaged plans or fund a flexible spending account. In both cases, the funds are borrowed from the government or bank and repaid over time as the pension is funded. This can be done to finance your business or income initiatives to help you accumulate wealth. 6. Long-term investments. A long-term buy-and-hold strategy can produce significant returns. The wealthiest investors have discovered that this strategy has helped them maximize the returns on their investments. This strategy involves buying investments and holding them for several years. These rich investors have chosen to do so with traditional stocks and bonds. Warren Buffett tries to follow the same strategy, and in a recent interview on CNBC's On the Money program, he stated that investors should not worry about sudden market fluctuations and should not follow them because to make money on investments, you need to invest in good companies and own them for a long time. According to him, to make money on investments, you need to invest in good companies and own them for a long time. If investors buy shares in good companies, they don't need to worry because their investments will be profitable even 30 years later. This is the strategy they should use, especially when they are young. If they use the compound interest calculations correctly, by the time they retire, they will have a good fund for life. 7. Strategic use of credit. A U.S. trust study found that 2 out of 3 high net worth investors believe that credit is a good way to build wealth. Additionally, 4 out of 5 wealthy investors know when and how to use credit to their financial advantage. First of all, this strategy involves a series of risks. Credit is expensive. But smart people can make it work. Let's see how they do it. Those who pay off their credit card balance in full every month can use loyalty cards to get cash back or rewards for expenses they have already incurred. Additionally, instead of rushing to pay off student loans and mortgages, which are considered low-interest, fixed-rate loans, they can pay off their debts on time and use the extra money to increase their retirement savings. In both cases, the money provided by the government or bank is used to fund the pension while paying off the loans. This way, they can finance businesses or income-generating activities to start accumulating wealth. 8. Keep an eye on trends and your peers. Many people try to copy the behavior of their peers. And they tend to spend a lot of time trying to outdo them with their strategies. However, it's important not to get sucked into this ridiculous competition that helps the personal wealth-building process. Rich people do things a little differently. They are aware of the competition. That's why, before making investment decisions, they define personal investment goals and long-term investment strategies. Rich people have an idea of what they want to achieve and where they want to be in 10, 20, or more years. They stick to their investment strategy because they know they will eventually get there. Rather than chasing competitors or fearing an imminent downturn, they follow a predetermined path. 9. Portfolio rebalancing. Financial illiteracy is a serious global problem. Even if it's not taught in schools, everyone should learn the basics and become financially prepared over time. This is especially important for investments. Everyone should understand and regularly practice portfolio rebalancing. Regular portfolio rebalancing ensures that your investor portfolio is relevant, diversified, and proportionally allocated. What is a balanced portfolio? A balanced portfolio includes an appropriate mix of liquidity, stocks, and bonds, depending on a person's risk tolerance and age. High net worth and ultra-high net worth investors consider rebalancing essential. They rebalance their portfolios weekly, monthly, or annually. They rebalance their portfolios regularly and without errors. Those who don't have time to rebalance their portfolio entrust it to a competent professional. They can also set rebalancing criteria with their investment company based on asset prices. This is an important strategy that everyone should have. Controlling your investments will ensure their growth. 10. Delay gratification. Instant gratification is not necessary and should be avoided. High net worth and ultra-high net worth investors know that long-term goals are much more important than satisfying current needs and desires. If you really want to build wealth, it all comes down to one thing: development. Cultivate the ability to be content with procrastination. If you spend first and save later, you won't have anything to save. Try to save first and spend later. At least you'll have something left over. Let's say you save €100 per month for retirement. If you keep saving for 20 years with a 5% return, you'll have saved about €40,000. But if you were to spend those €100, you would lose a significant portion of your earnings in just a few years. It's clear that your current needs are important to you. But if you keep money, investments, and the understanding of the difference between needs and desires in mind, you will be on the path to accumulating wealth like rich people. We are interested in discovering your personal experience on the topic. Write it in the comments and feel free to ask any questions. We will be happy to interact. Feel free to leave a comment so that we can improve the content. Your like would be the cherry on top, and click subscribe to stay informed about upcoming publications.